Stocks, bonds, mutual funds are common ways of investing to future-proof your wealth. But with recent geopolitical conflicts, market volatility, choosing the right blend of investments to reduce your risks could be a bit tricky. Here to discuss investment diversification is Peter Sashecki with Everything Financial. Good morning, Peter. Good to see you.
Good morning.
Okay, so let's understand what is diversifying your investments look like?
Diversifying means having your investments in all different asset classes. So some's Canadian large cap, small cap, bonds, U.S., could be some real estate, European, all over the world. That's what diversification is having things in different sectors or different asset classes all over the world.
What might work for one person as far as diversification is concerned? Why can't I say that? Diversification.
It's a tough one, yeah.
Too many syllables. It might look different depending on the kind of investor you are.
Correct. And the higher the risk level or the appetite for risk with an investor, the more equity, the more stocks they would have in an investment. Whereas a lower risk person might want more fixed income, more bond material, something more conservative, what they see in theory as being a little more stable.
What does a stable situation look like?
Well, really what you want to look at, we always talk about the longer you look at 3 to 5 or 3 to 10 years, and don't look at, and I always say this, don't look at the rate of return, look at the difference in the rate of return over 3 to 10 years. And if that difference is maybe only 1% plus or minus, no matter what the rate is, if it's plus or minus 1%, it's a lower volatility portfolio, because you can have a portfolio with a lot of equity, but maybe it's not really high risk equity because there's different types of equity. So don't think just because it's equity, it's high risk. And that's where you really need one of the portfolio management companies, the investment planning model with those companies, to really look at the investment structure and find one that works with a registered financial planner. So the registered financial planner will build the portfolio, or the financial plan, and then the investment company will build the portfolio to match and complement the financial plan. So having two people on the team there can help you with the right diversification and the right plan.
With someone who has a low risk tolerance and kind of look at the long-term plan, or compared to someone who has high risk tolerance, would that look different when it comes to diversification with that investor?
Huge. So some companies, you might go to a company and what they have in the stocks or in the portfolio might be the exact same 50 to 100 choices, except the higher risk person will have a bigger percentage of, say, the equity portion, and the lower risk person will have a bigger percentage of the fixed income. They can have the exact same investments, just a different percentage of each.
Okay, so finally, let's talk about the difference between passive and active diversification.
And that's huge. So your mutual funds tend to be passive, where they're just picking them. You hear, let it ride, or don't touch it, or stay and hold, and blah, blah, blah. But then when the market goes down, they're still not changing it, and they're just waiting for the market to recover. An active company will look at that drop in the market as an opportunity and sell off maybe the stuff that's high, and this happened when COVID hit, and then buy the companies that are artificially low right now because of the market. So active investors or active portfolio management companies are really doing their purchases for conservation of principal, and by conserving your principal when the markets drop, you tend to make more money and recover faster when the markets go up. So active is much better than passive.
Buy low, sell high. Buy low, sell high.
Yeah, buy low, sell high, diversification, all those catchphrases.
Yeah, learning them slowly. Peter Sashecki, thanks for joining us this morning for your insight.
Carrie.
Okay.